Marcus Grubb, he's the MD of Investment Research at the World Gold Council, the institute that just published that report that Caroline was talking about. Marcus, hi.
Morning.
Let's start with the second quarter, then we'll look ahead. I mean, it's phenomenal, isn't it? Demand did fall, but on a worth basis, on a net worth basis, second strongest quarter ever, wasn't it?
That's right, by value, absolutely.
Yeah.
Tonnage fell 17%, but the only reason for that was a decline in ETF purchasing in the second quarter of this year compared to the second quarter of 2010. Now, that's partly because that quarter in 2010 was a very strong number. So I'd say it's a little bit artificial in that overall, if you look at all the other categories of demand, technology, jewellery, India, China, central bank purchasing, they were all very strong in Q2.
Talk to me about India and China. I mean, it's phenomenal, isn't it? And it's a trend
Yes.
that you say it's set to continue.
Absolutely. I mean, if you look at them now as a sum total, they account for over 50% of both bar and coin investment and jewellery demand on a regular basis. So they really are key drivers now to the gold market.
You do wonder, though, Marcus, at these levels, around $1,800 an ounce, what sort of price will be prohibitive for the Chinese, for the Indians going forward?
Well, it's a very good question. I think, though, what a lot of observers are seeing is there seems to have been a change in the price elasticity of demand in these markets. In the past, you would have seen a reduction in demand and an increase in recycled gold as the gold price rose in India and China. Now you don't seem to be seeing that. Demand's remaining strong and recycling is very weak.
So is that trend something you think, is this a new paradigm we're witnessing in those countries?
I think there's some evidence of that, because what I believe is occurring is you're seeing strong wealth creation in those countries. Households are going to be significantly wealthier in another 5 to 10 years in both India and China. The rate of urbanization is increasing. Although there is high inflation, it's actually a symptom of strong economic growth in both countries. And as a result, gold purchasing is very strong. And you have to remember, in both these countries, savings rates are much higher than in Western countries, 25, 30, even 40%, and gold's a very easily available liquid asset in both countries, unlike in a lot of Western countries. So I think it's really being driven by a long-term wealth effect. It isn't a short-term phenomenon.
Let's look forward, Marcus, because you do say in your report, we expect the upward price trend to continue. I've talked to enough of your colleagues in the past to know you won't give price targets, will you?
That's
You won't
right.
give a forecast, but
Yeah.
you know, you are saying you expect the price trend to continue. Can you just elaborate on that, obviously without giving a forecast?
Yes. Well, I think if you take a step back, I think the key thing for me is two main things. One is this quarter shows that for a strong gold market, you don't necessarily need strong investment. This is a quarter where the ETFs were weak. They were much stronger in Q3. We already know that because of the sovereign debt crisis in Europe and the downgrade of sovereign debt in the United States. So looking forward, Q3 is going to be very strong in investment. We already know that. But if you take a step back also looking at the market, I think what a lot of people haven't appreciated is there's been some very large demand-supply swings in the gold market in the last 18 months. Central banks used to sell 400 to 500 tons. They've already bought 198 tons this year. China used to make no net contribution to the gold market. It would consume its own mine production and have no net effect. Last year they imported 260 tons. This year they're probably going to import well over 300, maybe as high as 400 tons in 2011. So there's been a huge shift on the demand side in this market. And I believe what that means is this is a market in deficit, not in surplus. And as you've seen earlier, mine production is rising, but it's not rising fast enough to keep pace with the growth of demand. So overall, that looks to me and to the World Gold Council as a very strong market which will underpin the gold price.
And I suppose if we get QE3
Yes.
from the Fed, that could really provide a fillip for gold, couldn't it? As it
Yes.
did with QE2?
Well, exactly. And so what you've got is two very strong drivers. You've got the fundamental demand for gold from the East, which is cultural, long-lived, based on high savings rates. And you've got the deficit problems and the debt problems in Western countries, high output gaps, high unemployment, sluggish economic growth, possibly a return to recession or even deflation is now being feared. And in that circumstance, you're seeing very strong investment demand in Western countries for gold. So you really have a sort of perfect combination of longer-term factors in Asia and more medium-term investment drivers in Western countries.
Marcus, fascinating. Thanks for joining us today. Marcus Grubb there from the World Gold Council.